Today, let's ask the question, what is monetary policy? Monetary policy is a crucial economic tool employed by central banks to manage a nation's money supply, interest rates, and overall financial conditions. The primary objective of monetary policy is to achieve specific macroeconomic goals such as price stability, maximum sustainable employment, and economic growth. Central banks implement monetary policy through various mechanisms, with interest rates being a central component. By adjusting short-term interest rates, central banks influence borrowing costs, spending, and investment decisions. When the economy needs a boost, a central bank may lower interest rates to encourage borrowing and spending. Conversely, during periods of inflationary pressure, they may raise interest rates to cool down economic activity. Open market operations represent another key tool of monetary policy. Central banks buy or sell government securities to control the money supply and influence interest rates. When central banks purchase securities, they inject money into the financial system, leading to lower interest rates and increased liquidity. Selling securities has the opposite effect, reducing money supply and raising interest rates. Reserve requirements, the proportion of deposits that banks are required to hold in reserve, are another tool used in monetary policy. Adjusting these requirements can influence the amount of money banks have available for lending, impacting overall credit conditions. Quantitative easing is a more unconventional strategy employed in monetary policy. During economic crises, banks may engage in large-scale asset purchases, including government bonds and mortgage-backed securities. This infusion of liquidity aims to stimulate lending, lower long-term interest rates, and encourage investment. Monetary policy is not without challenges. The effectiveness of interest rate adjustments can be constrained when rates are already near zero, as witnessed in the aftermath of the 2008 financial crisis. Central banks must then resort to unconventional measures, as seen in the widespread adoption of quantitative easing. Additionally, there is a delicate balance to strike between stimulating economic growth and managing inflationary pressures. Central banks must carefully assess economic indicators and respond judiciously to evolving conditions. In conclusion, monetary policy plays a pivotal role in shaping a nation's economic landscape. By influencing interest rates, money supply, and financial conditions, central banks aim to foster stable economic growth and maintain price stability. The nuanced execution of these policies requires a deep understanding of economic dynamics and the ability to adapt to changing circumstances. Please note, while we may discuss finance, investing, and money on this channel, this video should not be considered financial advice. When investing or making plans for your own financial security, please seek the guidance of a licensed professional capable of making more informed decisions. If you make a financial life decision based upon the content of this video or channel, then please do so at your own volition and at your own risk. This channel and the people associated with it should not be held liable for your investment choices.